Hello, everyone. Welcome back to the Rational Investors color commentary around FOMC event windows. We do these videos every once in a while. I don't think I'll put my camera on. We'll just have it talking in the background. As you can see, markets are moving on the announced interest rate reduction out of the U.S. Federal Open Market Committee down in the States just a few minutes ago. We've been waiting a while for this event. There we go. I can hear myself on YouTube. That's good. So while we're waiting for Jerry to get going here with his press conference, which usually kicks in about the bottom half of the hour in about 5-10 minutes. I would just maybe talk a little bit about the backdrop. As you can see, clearly markets are moving appreciably. And the headline here posted in the lounge just a second ago. We have a fairly active community here at TRI, so we're all sort of watching with bated breath. There is the announcement. 5%. Market previously was 5.5, so a fairly sizable reduction, 50 basis points. And the headline here is they are responding to weakness in the housing market. I suppose last month's data that came out was a bit shocking for them. Showed, I guess, housing starts down about 6 or 7%. But the irony of it all is that today, and I don't know whether they took today's econs into account, but you can see today's housing starts data came in increase of 9.6%. You're lowering interest rates in the face of that. This whole thing stinks. It just, I'm sorry if I'm going to be slightly jaundiced about all this. I think this is more to do with politics than economics. And this modern day 21st century, I'm actually quite shocked at how brutally political a lot of this is. And the political situation in the world right now, it's so polarizing. And I get the distinct impression that the 1% will do anything possible in their power, including, I hate to say it, but it sure seems like it. They did it to Jackson. They did it to Lincoln. Actually, they tried to do it to Jackson, but he survived, I suppose, just like our buddy here now. They did it to Lincoln. He didn't survive. They basically steamrolled Woodrow Wilson. And really, that's sort of the foundation of the destruction of our modern day society is pretty much on Woodrow Wilson's shoulders, which is so ironic, because of course they won't teach that in schools. And of course they did it to Kennedy. Mind you, Kennedy made enemies all over the place. But the banksters certainly didn't like Kennedy for introducing the Kennedy silver dollars. Did it to, or they tried to do it to Reagan. I think Reagan got religion pretty quickly and changed his tone and his tune 180 degrees and completely supported the banksters' crookery. Now you can see they've gone and tried to extricate. That's probably not the right one. Just tried to get rid of the guy who could upset their plans here in the near term. Twice now. God, incredible. Anyway, on the release of the news, obviously you can see a pretty dramatic reaction from the market. And what'll be interesting to see is if the market keeps these dramatic reactions following the conference. I wouldn't be surprised if you actually hear from the Fed that, we've gone and changed rates, but we don't plan on doing anything more for a long time. And you probably sit here with this reduction today as sort of the only rate decrease that we see for a while. But again, me personally, if you're asking my opinion, I think this is entirely politics. And of course, Jerry is going to explicitly say this has nothing to do with politics. But remember, Jerry's a lawyer by trade, right? We all know what lawyers do by profession, right? If the glove doesn't fit, even though you kind of know that he did it, you must acquit. So anyway, I had sort of counseled the community that really what we had to watch for was how the ES was going to act at this very important pivot. Actually, it's probably better to look at the cash market. Do we go and cup and handle? Or you can see just in the near term here, we were potentially forming a diamond. And if, of course, we broke through the floor of the diamond, oh boy, all hell could break loose. Let me go right back down. So you can see the knee-jerk reaction, the initial reaction. We actually even have a W here way up top. You can see the inertial reaction was a break of the diamond pattern to the upside. And I simply told the community in our daily video here first thing this morning that if we get a close above the diamond, that's easily a buy signal. And you can see that's basically a cup and handle pattern. And wow, holy massive, insane upside targets. And I got to say, with them cutting interest rates, the bank stocks, they're going to be happier than shit. I mean, do they change the rates that they charge you on your credit card bills on a monthly basis? No. So keep in mind that these banks do nothing more than borrow at the short end, or basically what, the Fed funds rate is, and then lend out to the public at interest on the long end. And the spread is their profit margin. And of course, they've got, Joe Sixpack up to his eyeballs in credit card debt. So, the banks, they're just absolutely loving it. And we got lots of further anecdotal evidence of that. California is going to be giving away down payments. Sure, the taxpayers of California sure love this. I went on at length in the video today about how insane that plan is, but just basically giving away money to people that don't have any money. You don't think that this is going to end badly? I don't know. What are you saying there, Chris? Sorry. All right. I actually see that it still says live watch September 18th. Is your video kicking in, or am I watching this delayed? What am I watching here? Yeah, does this thing need to be refreshed? Oh yeah, there he is. Okay, so yeah, they've got the room going. So Chris is going to put this in a little side corner. There he is, Mr. Wonderful himself. So let's head on down to the lower time frame charts. I always love to watch the volatility as he talks and as questions are asked. So let's hear what he's got to say.
Employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the beige book.
Artificially high.
We took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based
Sure.
on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago,
those stocks
when
coming
inflation
off.
was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Commodities,
Christian Gabriel,
commodity currencies
Associated
are all
Press. Thank
topping
you.
out here.
The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level, so that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19
still
of the
selling off.
participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina?
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick?
Ooh, stocks like that.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. But so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain
So
equilibrium?
I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the
Ooh,
form
big
of our
program
confidence that
trade there.
inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby?
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael, Keith.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to
stock
slow
snapped back
unexpectedly,
nicely.
then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we've had,
Watch out the bonds act here.
adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months, and so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report.
Can we murder Trump?
We get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you
Ooh,
view
he
that
wants
level of
to have
job
his
creation
baby.
as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are, it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now.
That counter trend rallies
My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. Again, we only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my 4th presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it.
Whoa, lying!
That's
Did you
what
see
it
how
is.
high
It's
he
never
touched his
about
head
anything
there?
else. Nothing else is
Cocksucker.
discussed, and. I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people.
Look at all these M's.
If we
Holy
get it right,
shit.
this will benefit
Look
the
at those
American people
bonds.
significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't
Look at
put
the
up any
M's
other
in the
filters.
stock
I think
market.
if you start doing that, I don't know where you stop. And so we just don't do that.
Sell.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply,
Another
what
one wants
message
her
are you
baby.
trying to send American
His
consumers,
baby.
the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place. and our
freaking out.
decision today
The
is designed
Rothschilds
to keep
told
it
us
there.
to act.
More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor
Whoa,
market
look
is
at
still
Bitcoin
in
and
solid
Ethereum.
shape. So
Oh,
our
boy.
intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Market is taking interest rates the other
Just a follow-up
direction,
to that.
sir.
Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%.
Look at the
And I think
long
we're gonna
bond
wanna
just
see it
puke out
be,
here.
Around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So
9.6% rise in
the one
housing
piece
starts.
That is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation, over time that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more.
Stock market didn't like to hear that.
What's the likelihood of that, and
Bonds
how
still
do you
haven't
react
bottomed.
to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that
look
we
at all
have
the M's.
had and
Ethereum Ming
are on
out.
track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Look at long-term interest rates keep going higher here.
Hi, Victoria Guido with Politico.
That'd be
Just
hilarious
following up
if
on some
fucking
of the
mortgages
labor
actually
market
ticked
talk
up here.
earlier. Monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, Do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time. As you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However,
should be an interesting level on the U.S. dollar to watch
will
here.
really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to
you've been
the public
great resetted.
Get
used to it, suckers.
We had we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant. But at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Get used to it.
Hi,
Yeah, looks like stocks are hanging in here. Looks like the bonds turned back
if you could
up.
go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The
Vague
Economist.
question and vague
You mentioned
answer.
how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries
that's
that are
a
sort of like
setup
the United States,
question.
all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice
he
Chair
wants his baby
Supervision,
too.
Michael Barr outlined his views
there's a
for the
handsome
changes
guy.
to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And
Interesting
then,
how the
yesterday,
gold's breaking
other
down
banking
here.
Regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that.
There
And
goes
as for
the
the
gold.
other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday, there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate
looks
growth.
like stocks survive.
Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place.
Yeah, and
14
breaking
months
down
ago
with
was a
gold.
stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
Fascinating. So that's it for Jerry. Notice the one thing he did not mention, didn't even make reference to how the international and global economy is acting. I've said this all along, folks, and I don't know whether I'm just talking to myself or not, but I don't think this has anything to do with the U.S. economy, and it has everything to do with the global economy. It's fascinating just watching this. Clearly halfway through, something was said. I'm not even quite sure exactly what it was, but you can clearly see something happened right about here, and the whole market just puked right out. And, while he was blabbing away, I had said, holy crap, watch the bond market. I don't know whether have you been watching these shows that we do through the FOMC press conference, but 9 times out of 10, you always have to watch the bond market. The bond market leads everything here. And the bond market clearly heard something that it did not like at all. This is the long bond, the U.S., I guess that's like the 30-year treasury. I'm not quite sure. It might be a amalgamation of 20 and 30-year paper. But right across the board, these are bond prices, which means that rates are the inverse. So, they announced they're going to cut interest rates. And of course, the bonds start off going, woohoo, interest rates are going down. Hey, awesome. And then something happened and everything just rolled over hard here. Now, what'll be interesting, especially with regard to the short paper, because this is really the market's proxy on Fed funds right now, because they systematically removed the euro-dollar market, which was my favorite market, to follow the Fed and make sure they stay honest. But clearly, they didn't like the public having that tool at their disposal. So they tried every effort possible to get rid of it, and they killed the euro-dollar market, which is terrible. But anyway. So we have to watch the 2-year paper. This is the 2-year Treasury bond. And as I said there a moment ago, right out of the gate, hey, we're cutting rates. All right. So the bonds are like, woohoo. And as he was talking, these bonds kind of went, oh, I don't like the sound of this. This sounds to me like there's more inflation coming down the pike. And they rolled over, and everything rolled over as soon as they broke. And as soon as these guys started to roll over, and we saw that the stock market started to roll over, and you even heard me barking going, holy crap, look at all these M's. So we'll see how this goes. These are very lower time frame charts, but it is interesting just to sort of get the feel for what the market was hearing and sort of what the knee-jerk reaction was. And I had said halfway through the broadcast, I don't know whether you heard me, but I said, you know what, we better pay attention to this US dollar. If we actually recapture this fail candle high here, that's going to actually represent a bull flag, which means that the US dollar index probably going to want to rally right back up top here. And you can see here is sort of the tick by tick chart. Higher highs and higher lows defines a bull. And interesting to see our beloved Bitcoin. Oh no, is that a smile within a smile? 2 M's? Oh boy, look at Ethereum. Yeah. Ugh. And actually, I did see somebody on the YouTube channel even point out that, I don't know, it looks like these rallies all just basically, they rallied everything right into resistance, and then everything just sort of melted back down. So I suppose if we take a look at a little bigger picture, where's a good chart for that? Over here. Let's see what they're doing on the little higher time frame. So, wow, can you ever see the reversals over here, eh? So, as I said, like the big concern, and we live in a debt-based society, right? You hear these stupid bankster crooks. Their ideal world is for you and I all to be up to our eyeballs in debt. Why? Because they lend you money at interest. So if you're fucking up to your eyeballs in debt, then that means the Rothschilds are getting nice big fat monthly checks. And that's the way this stupid game goes. And sadly, this whole inflation conversation is really nothing more than, oh shit, we've issued so much debt. What are we going to do? The debt that we've issued is bigger than the size of the economy. I know, let's go and monetize the debt, print the fuck out of the currency, and all of a sudden, boom, the size of the economy is so much bigger. And now the debt that used to be really, really big, bad and ugly as a percentage of GDP, it's not so bad. So we can issue more debt. Woo! So, this is absolutely perfect scenario for these bankster people. This is beautiful. And, you heard me before we got going because, something's happened in my country, which just makes me sick to my stomach. But the government is in cahoots with this, and they just went and raised the government guarantee on mortgages. They literally raised the guarantee by 50%. What? So, get used to it. We have all been great resetted. I don't understand why more people aren't cluing into this, but anyway, it is what it is. As we sort of said, I think the big thing that we want to take away from this is, are they laying a trap here on the US dollar? And it feels like it, the way that this is turning into some sort of hammer now. We'll see how this candle acts. And like I said, off of those lower time frames, if that turns into a bull flag, that might be a pretty big trap that they just laid there. Looks like the stocks are recovering the sell-off. Bonds don't appear to be rallying too smartly, but you can see Got a little bit dojis coming in here now off of these sort of half-hour charts, but look how the stocks are just taking back those losses instantly. And it's interesting how it's being led by the Dow stocks. Why? Because the Dow, of course, obviously has a whole bunch of financial stocks, banks, and all that. And as I had said earlier, lower short-term interest rates is just music to the banksters' ears. They will still charge you insane interest rates on personal loans and first things like credit cards, but now their cost to borrow on the short end has depreciated dramatically. It's interesting to see crypto's trying to stabilize here. This is an interesting sort of side proxy. I like watching Litecoin. It's sort of like, I think it's a great indicator for sort of like the broader crypto market. You know, these guys here, I think they are basically securitized. Whoops, I'm not quite sure what I did there. But I noticed that Litecoin kind of is flying underneath the radar. Also, too, interesting to see, you know, Ethereum did have a double bottom working coming into that event. And actually, I guess this is the bottom here and on that event. Oh, those lows are holding. We did have a pretty bearish setup. If anything, it almost looked like maybe Ethereum, the bear move was getting a little bit exhausted. That was the impression that I got. Looking at good old corn, actually interesting how we were talking in the video this morning off for this site. I had kind of suggested that, you know, it sure feels like we could take another leg up higher here. And this felt like a little bit of a trap. You know, if they ever put in like a market structure signal right ahead of a Fed meeting, yeah, you might want to take that signal with a grain of salt. And sure enough, they're just running stops all over the map here. But as I sort of said in today's site video, I wouldn't really get a buy signal here per se, as you can see, squiggly line theory for the win, until we actually break this downtrend line. And I think this is in reference to somebody on the YouTube channel saying, well, they rallied it back into resistance, but that's about it. So for me to get like outright bullish here, I really need to see them punch above this trend line, put in some sort of bullish structure down here, and then we could probably take a run up top. So I think the jury's still out. But having said that, it looks like the knee-jerk reaction so far is back to risk on. Okay, let's put crypto away. You got the stocks catching a bit of a bid. We'll see whether they can break out, but I suppose that's good. You've got actually the international currencies. Remember, I said we should probably watch this US dollar really closely here. It has technically made lower high and lower low. I suppose because that is an M, we can actually even do things like Foggenbaums. So that actually implies that's a bearish chaos pattern. So let's see how the market reacts. I mean, it'll be interesting to see how Asia opens up here. But 2.618 looks like we could very easily, if this, pattern holds, you could argue that that's a bit of a consolidation in a bearish pattern, which would be projecting down into these levels down here. So we'll keep an eye on how that acts. The question I have here, though, is considering this rather sizable tail, this is a daily chart, so it won't finish for probably another few hours at best. But it'd be interesting to see what they do here. Having said that, I wouldn't fault you if you were like, well, Brian, that is an M, so I am thinking lower. And actually, the one thing that actually caught my attention, I was a bit surprised at, if this US dollar is actually breaking down, then we should see things like the gold actually move up smartly. Unfortunately, because of the high volatility in the market, a lot of this might just be noise here in the short term. But interesting how silver could not break out through the top there. Big counter trend rally back up top and then failing. And then the gold, same thing. Big counter trend rally right back up top on the announcement and then failing. I hate to say it, but what are we supposed to think if we see the market smiling at us? So just be aware. And I might argue, this gold market, it's coming off a long way. So could we use maybe a period of calming down here a little bit, maybe back to key support or something just to clean this up? Looks like we're coming into some, I don't know whether that's horizontal support and resistance or whether, actually, you know what? That's nice bullish bot ABCD objective was just hit here. Oh, look at that. I didn't even notice that. So is that maybe a little bit done there for the gold? I mean, I really don't like the idea of coming in and buying gold there. That doesn't make any sense to me. So I'll keep an eye on that. Probably, if you are a gold bug, you probably want to keep an eye on the Swiss franc because to all intents and purposes over the years, especially since they told the Eurozone to go screw themselves there a few years ago. Swiss franc basically is a gold proxy in the marketplace. So what's this guy looking like? Is he wanting to break out higher, or are we getting a bit exhausted? Fascinating how we're right up against key resistance there. Haven't broken out though. So usually they say that the currencies lead the commodities. So maybe that means gold's got a little bit more to go. I don't know. Tough one. Not really any definitive message here. Having said that, man, look at this volatility. Wow. This, if anything, you probably heard me say this once or twice in the past. If you haven't, probably maybe a good idea to write this down. But there's an old rule, right, that just simply says do not trust anything that you see out of the market for at least a full hour following the Fed announcement. And this, my friends, is exactly why. If you had made a big bet heading into that event and maybe you'd seen the initial reaction was one direction, look how the bonds keep selling off here. Oh boy, look at that. They're breaking down. Look at that. So this is the long U.S. Treasury sitting on its knees here. That's not rallying. And interesting here is that 2-year paper, the sort of the Fed funds proxy. It hasn't broken down. And I suppose that would be real egg on the Fed's face if they went and cut interest rates and this thing broke down, i.e. 2-year rates were moving higher. That'd be hilarious. But see, this is the interesting question that I asked during this. Like bonds, because of our debt-based society, bonds lead everything. So I always say, well, currencies lead everything. Well, you could argue currencies are nothing more than a form of bond, especially this fiat world. Theoretically, the only value of fiat currencies is the full faith of fill in the blank government, what they're going to pay you short-term paper, right? I mean, is that not a bond? And even the currency that we use, at least the US dollar, it says right on the bottom, right? Reserve unit. This is technically an IOU that you're actually passing back and forth amongst yourselves. I don't know whether you're aware of that or not, but anyway. So I'd be very curious, like what I want to, number one, I like to follow this as the inflation deflation gauge. Somebody did correct me recently and said, well, the TIPS is like a 5-year bond and the TLT is a 20-year bond. Regardless, this relationship works very, very well in my eyes. And you might argue that I would argue that the whole sort of talk about inflation was nothing more than the absolute insane over the top spending by all these Western governments. Down in the States, for instance, they passed a whole bunch of emergency spending bills and stuff to try and support the economy through this sickness. Are you aware that they actually still have all of those emergency spending programs and the dilution of the currency and the absolute insane money printing? That's all still going. I didn't know we were still in a poor economy. So that's what your inflation's all about here, folks. I do find it interesting that over the past little while, where the Fed's been getting in front of the inflation problem, raising interest rates. I mean, you could argue, they really got religion in here because guys like Stanley Druckenmiller are like, you're fucking destroying my country, you assholes. Stop this. And if anything, thank God for Stanley's of the world, because if it wasn't for him, they wouldn't stop at anything. You heard me chiming in my 2 cents while all that was going on. I mean, I I personally believe, as a market participant for 35 years, I also fancy myself a historian and a student of the market. And I don't believe these FOMC and Jerry when he says that, we do everything in the service of the US citizen stuff. That is just, in my opinion, that is just an outright lie. They don't work for US citizens. If anything, they work for the US corporations and what serves their purposes. And obviously the FOMC, the Federal Reserve Board, is nothing more than a cartel of one particular industry within the United States of America, the banking industry. So that's who these people work for. Don't kid yourself. I do find it interesting that they sort of kind of got religion here, but you notice this number is still very much positive. We actually, believe it or not, we actually went through almost a generation of, we should have been going through deflation. But through that period, what do? They take interest rates to zero. You even saw, you heard Jerry talking about, negative interest, negative yielding sovereign bonds and all that kind of fun stuff, because that was a particular cycle that we were going through. So ironically enough, through that cycle, that's when we should have seen prices falling. We're not in there anymore, right? This is the Jupiter-Saturn cross. I think you can make the argument that you can pretty much set your watch to when this crosses. We go through these money cycle events. I watched it happen in 2000. I was a child in 1980 when it went through, but I watched the way that my old man was run through the ringer by these stupid banksters through that. And I would argue that that was your pivot. And I would, just as Jerry said, I don't think none of us, the sad thing is our lifespans are so short. None of us will be alive the next time we actually go through that particular part of the cycle again. Right. The next time we go through a cycle like this will be, I guess, officially, the year 2100, eh? So it'll be a good 80 years from now before we get back into this kind of thing. None of us will see it again. In fact, I would actually make the argument that what we should do here, believe it or not, unfortunately, I can't see it on this chart. But I think that we're probably going to have to come back and play with this slow. Yeah, you can already see I've already had this conversation before. So at best, I think we're probably the inflation deflation conversation. We should get a deflationary push into these levels, but I don't think we'll ever see sort of those negative yielding sovereign bonds ever again. So, and if anything, as I had sort of started the conversation off with, this has absolutely this has very, very little to do with the United States of America. This has everything to do with this Winnie the Pooh stupidity over there in China. And I might argue that that was basically a generational trap. And their buildings are falling down. I watched videos recently of like literally sinkholes just start opening up in the middle of major cities because there's just so much corruption and shit. But I wouldn't even be surprised if all of those buildings, the whole ghost cities and shit that they built over there, they all just disappear and they all become ghost towns. Anyway, we'll see what happens. So I believe that we went through a major cyclical pivot there. We've had the dead cat bounce out of that pivot, and now we're in the aftermath. Blame it on Jupiter Saturn crosses, blame it on, interesting how nobody really in the West even talks about the insanity of that Chinese economy and what happened there. But it's an absolute disaster there now. When you can blame it on that pivot, you can blame it on, I think the dream of the Eurozone and everybody all being nice and friendly in Europe, I think those days are long over now. So we're going to go through a period of Cold Wars with Slavic nations now for the next 10, 20 years. Who knows? Ironically enough, this is going back to the normalization of the world. But I guess what really bothers me about all of this is, and this is what scares me, like I said, the government in my country, we're in a situation now where so many people are so leveraged to this housing market that the politicians can't take the risk of the market actually breaking. Because if they do and house prices collapse, there is no way in hell these politicians are going to get reelected. I can absolutely guarantee you that. So now you can see sort of the politicians all scrambling to try and figure out, okay, how do we keep these high prices high? There's got to be a way to figure out how to do this. And, as I had started off the broadcast earlier, in California, they're actually threatening to, well, I think they've actually passed the legislation where literally the citizens of California, whether you like it or not, if there's some Yahoo that's just swam up on the shores or hitched a ride on some, migrant convoy, they could literally petition. They don't even have to be U.S. citizens, don't even have to be legally even in the country. And they can petition to have the down payment for a house paid for by the citizens of the state of California. How insane is that? And that's how you keep the Fugazi going. And in my country, I told you earlier, they're going and they're like, they can't do the government guarantee down in the States because they already blew that up with the Fannie Mae and Freddie Mac, but they haven't blown up the government agency in my country because it was a different cycle, right? I mean, Canada's a commodity country, so it did relatively well in the fear cycle. But the government agency, and I wouldn't be surprised if they do this to try and prop up these real estate prices, you're probably going to see it around the world. All of these, socialist governments going to figure out ways to prop this shit up. So the point I'm trying to make out of all this was, you as a consumer wanting to get the most for your buck, and keep in mind, wages haven't really moved a hell of a lot. And the central planners, they really don't want wages to move because that's when inflation will get absolutely out of control. And I think that comes in like 10, 15 years. But if you wanted to see some sort of stability in prices, you want to see M's. And you want to see big structural M's. Like, so for here, for instance, if this thing was really done, then we would have seen a big structural M come in here. I am now officially heading down. But notice those M's, the little cute little M's. Oh yeah, politician's going to throw you a bone or something. And that's going to get a media soundbite and it's going to calm things down for a bit. And then boom, back up we go and lots of W's. I hate to say it, folks, but I'm seeing very similar type of price action here. This is going back to the end of 2023. You heard Jerry talking about, oh God, we better. In 2023, we were looking at a very different situation. Inflation was out of control. We had to get in front of it. Interesting how that's just a V top. So there was no structural signal there whatsoever. They rallied it right back up. But, if you're a fan of that ICT guy, then what you really want to see is you want to see the market punch down, break this support, right? Bull market, higher highs and higher lows defines a bull. So, if you're a fan of that ICT guy, he likes that kind of thinking. I think he calls it like a market structure shift or something like that. And then you want to see the counter trend rally back up into things like reload zones and all that kind of stuff. And that actually sets up a really nice short and down you go. But we haven't done anything like that. We are making higher highs and higher lows. And I would just argue that really over the past year, we haven't really done anything, right? We're just, you could argue that September of 2023, that's exactly where we are right now. Nothing's changed. This is the bothersome part about this. Nothing has changed, but that doesn't mean prices are coming back down. That means that just prices are stable. What happens if this son of a bitch goes and comes up and breaks out through here? Oh my God, that's more of this damn W shit, and we're right back in the soup. So, there's really nothing that's been done here to help you and I in the market here. This was just, holy shit, Stanley Druckenmiller's shitting on our heads. We better do something because these 1%, you guys, they're getting pissed off at what we're doing here. We got to slow the pace down. But they're not reversing. If this thing really is actually, we're going to get some stability. You heard them talking about the housing market. They haven't got in front of it. Housing starts up almost 10%. Hello, that's not deflationary. That's not even disinflationary. So if you want to watch a market for sort of your cue as to whether the inflation problem has actually been dealt with, I think this is the chart you want to follow. And right now, folks, I'm sorry, but all we are is we're just wedging out. I don't know which way this breaks, but for us to actually believe that the inflation problem has been dealt with, we have to see the market structure failure here. And really what we'd like to see is them break these previous bullish higher highs and higher lows structure. So, I mean, that's the shitty part about this. I know it's probably way too long-winded. Sorry, everyone. But I even put a tweet out the other day that really nothing's happened here, folks. They've gotten in front of the runaway inflation, thank God. But that doesn't necessarily mean prices are going to come back down to earth. And in a weird sort of way, you can kind of see this in the money supply conversation. But maybe we'll leave that for another day. So, anything else worth mentioning here before I let you good people go? We wanted to keep an eye on interest. Ooh, so here's some interesting. One reason why I thought that the ES was going to top out here was look at that. I mean, is there ever a reason to learn chaos theory? 2.618 chaos bifurcation level. And look how the market rallied up into that level and then rejected off of there. It's just absolutely incredible. Remember I had said when we got started, we want to keep an eye on how this diamond resolved. And I don't know whether any of you heard me, but what I said was we want to see a close above this level, right? The diamond, you can see it there, right? That's this chart. So look at what's happening here. This is interesting. So right off the bat, can anyone tell me? Actually, oh, that's good. And actually, we won't do trivia and all that. I don't think actually you people in the public like when I do that. So I'm going to try and refrain from doing that going forward. But anyway, we don't really necessarily have a fractal here. They tried to break the market out up top, but you can see it's running into some selling here. So this, I think, is a really, really good anecdote of why you can't really have any confidence in these diamond patterns until the market actually closes either above or below this level. Fascinating what's happened here. And how ironic into the close here today, really what they're doing is they're passing the buck. Because if they finish the market like this, that's very weak. Don't get me wrong. That's bad. Here's a really good analogy. What do you think I'm going to call these people going forward? If this candle finishes like this, and frankly speaking, it's only, we got 10 minutes to go to the close. You might find that they just bring this thing right back. But what would we call these people? Couch, maybe. Glass Insight says, we love the trivia. Oh, that's good. Fingerburger. No, you knucklehead. I don't know whether you're going to watch this afterward or not, but he wanted to talk to us. I wouldn't have minded hearing what Ed had to say. Ed is one of our awesome day traders. We have such a killer day trader room. I don't know these guys. So for some reason, I got hooked up with this group out of Sacramento, and they're just badass motherfuckers. So Ed is our TPO pro in the day trader room. He just has such a great time. And he's got Adam in tow with him, and Adam's turning into a 1 minute shark, just clipping the market here and there. He's just such a fucking badass. Hey, there he is, Adam. Yeah, that's right? These guys now, I don't know how this candle finishes. Maybe in the last, what time is it here? We got 9 minutes to go. They might bring this fucking thing back. Who knows? But if they finish this like this, and interesting how I said that this had to close below there, you can see they probe down there, and now they're like, oh, I don't know, bring me. Anyway, but these guys up here, they are the definition of trap bulls, right? Because they were all like, oh, this is a W, let's go long, let's go. And now they are so trapped. So this is fascinating. I got a ton of trap bulls all up in there. They might just get their heads handed to them, but really, really good analogy of that diamond pattern. It's a dangerous pattern, and you have to just let the market close out on, because this is actually going to make like a doji, right? So, I guess we're not going to see it. These are the S&P depository receipts. We don't really get a doji signal there. I will say though, on balance, this cup and handle here, it did break out. Maybe all we do is we pull back into moving average support, find some sort of structure, and then turn back up. But this will be interesting to see how the international markets react to what the Fed has done here now. And I think that's kind of what's going on is they've set the market up that it's weak. And now the question is, all right, the Asians are going to open up, and what are they going to do? Because remember, the Japanese, oh, Jesus, look at this. Look at the US. Oh, remember I had said this earlier. Look at the trap that they have laid here on the US dollar. That is an outright hammer now. We can't even call that a dragonfly doji. You got to call that a hammer. Hammer time. Look at these reversals. Holy Shiite Muslim. Wow, look at the stocks coming off here. Oh, what a mess. I tell you, these Fed days, hopefully you guys have been watching this long enough now that you guys respect the message that you just can't take a bet heading into the Fed here. And you can't trust anything that happens around this shit. You have to wait a good hour or two following. I mean, how many people have gotten totally trapped here? And this isn't just, I mean, you could argue just the exact opposite in the stock market. What would we call all these people down in this tail here now? They are trapped bears. I don't know. I mean, if this thing actually ticks up through that candle, we finish here. This is a daily chart, so it hasn't finished for a while. And we tick up through that high. These trapped bears here, they are so screwed. And really, I might argue right across the board. And we were even, where the hell's our Bitcoin? Actually, good to see. Of all the markets, Bitcoin's holding in here pretty well, I gotta say. Crypto, I mean, look at the stocks. Stocks are puking out here. And remember, we had said this. Oh God, I could talk all fucking day here. Okay, I think we should probably leave it at that. What do you think, Chris? Is there anything that I should have talked about? I mean, I suppose we can. Actually, you know what? I have a meeting I have to go to in an hour. So actually, you know what? I think I'm going to leave it at that. Most of you over there on the YouTube page, I think you guys are TRIers anyway. So come on the site and we can shoot the shit. Through the day. Tomorrow I'll be back on Friday. If you have questions, you want to review any of this that I've talked about here today, just go into the daily brief request room on our website and post your question. I'll be more than happy to either answer your question in the lounge. And I gotta tell you, man, some of these crypto charts are looking pretty damn good. And of course, good old fucking, I don't even know these people's names. DDBB, that's what we're gonna call you. I know you're over there on YouTube too. Our community is so fucking awesome. I mean, these guys are just killer traders. So anyway, interesting to see that they're posting comments. So I'm going to be busy on Friday talking to Mr. DDBB. And it also looks like here, Sean, there we go. Yeah, interesting render. So let's circle back around. If you have questions for me, make sure to post them. And Friday, we'll spend a whole bunch of time doing Q&A and stuff with you guys. So hope you enjoyed the broadcast. Hope you learned something. Hope you were taking notes. You should all had your journals out. Slow and steady wins the race. PMA for the win. I would suggest that you join our education program if you really want to learn how to build and manage a small business of trading. But actually, the term just started. So if you maybe talk to us really nicely, you can sneak your way in here. But just understand that the fall term is up and running. And actually, I was quite pleased to see. I have one business partner who loves to freak us out, and every single quarter he talks to us about how we're going bankrupt and how the site's collapsing. And actually, we have quite a few students, so I don't think we have to worry about going bankrupt. There's plenty of you that still want to learn from us and interact with us in our community. So TRI ain't going anywhere, and I'll look forward to chatting with everybody Friday. Like I said, I got to go take a break because I have a tutorial to do in about an hour with a lucky gentleman. Okay. Wow, look at the bonds just on their knees and continuing to head lower. Wow. All right. Have yourselves a great day. PMA for the win. Slow and steady wins race. Remember what your number one job is. Don't take no win. Bye for now.